This week, we're talking about something that actually gets missed a lot in our retirement planning conversations, and that's the taxation of your Social Security. In the spirit of financial education and creating informed consumers with our client base, we wanted to talk about something that typically gets missed, right? We focus a lot on the Social Security front around claiming strategies when you should actually start taking your Social Security benefits. But what actually gets missed a lot, and most of our clients don't fully understand, is how those benefits then get taxed once they're actually claiming those benefits. The taxation of Social Security goes back really to 1983 with the Social Security Act of 1983. A few unique things about this are certain thresholds that were put into place from how much of your Social Security was taxed at what levels. And a real unique thing is that there was no index for inflation over time. So those levels in 1983 that were established are actually the levels today. So one unique thing in general rule that we typically tell a lot of our clients is that most of the time 85% of your Social Security benefits will be taxed. So what I want to do is kind of go through what those thresholds look like and actually what goes in from an income standpoint to get you to those specific thresholds. So to understand how much of your Social Security is going to actually be taxable, it's important to understand first what your combined income is. So the combined income is simply your adjusted gross income, your AGI. We add in your non-taxable interest on top of your AGI. And then we take 50% of your Social Security benefit. We combine all that together and we come to your combined income. Once you have that combined income number, we basically figure out, are you an individual taxpayer or are you a joint taxpayer, and it will come up with some certain thresholds here. So I'm going to run through those real quick, and then you'll get an idea of how you actually come to a taxation on your Social Security. So if that combined income number is less than $25,000 annually, that's a 0% taxation rate. We don't see a lot of people that's the case for, but that is out there, especially now. Because remember, these were 1983 numbers that we're seeing now in 2021 and beyond. The second threshold, the second tier, is $25,000 to $34,000 of combined income. That would mean up to 50% of your Social Security benefit is then taxable. And then above that $34,000 threshold for that individual taxpayer, up to 85% of your Social Security is taxable. So you can kind of see the income levels, the thresholds are actually quite low, and most people end up in that 85% taxable rate on your Social Security benefit. So if we jump over to the joint side, married filing jointly, they give you a little bit higher thresholds. Anything less than $32,000 from a combined income standpoint, you're looking at a 0% taxation on your Social Security. $32,000 up to $44,000 is the next tier. So up to 50% in that tier of your Social Security is taxable. And then above that $44,000 threshold, the IRS will say up to 85% of your Social Security benefits are then taxable. Obviously, it's not you're not an 85% tax on those. It's 85% of your actual benefits. So for every dollar that you make, 85 cents of that goes towards your taxable income. That's really what we're looking at as retirement income planners, understanding what streams of income might be coming in from different sources, what buckets of money might be out there, and we help you put the whole puzzle together and optimize a tax and income strategy from a holistic standpoint. Hope you found this insightful. I'll talk to you soon.